Hi, I'm Pete Andresen with Andresen and Associates, and this week I want to talk about what happens if we actually do have a recession. We don't really know we're going to have a recession, but the evidence suggests that we will. The inverted yield curve, Home Depot's expectations for the future, there's some evidence piling up that a recession is quite possible. It would be completely normal if we do it. I'm going to take a moment to say that a moderate recession is a good thing. That doesn't sound like it's correct, but it is, because like pruning my avocado tree, capitalism needs to prune away the dead wood, and recessions do that. The banking failures we've had so far suggest that those banks weren't really correctly managed. That kind of thing gets pruned away. Jobs that shouldn't be there, that aren't efficient, that don't add value, corporate expenditures that don't have value. So a recession can be a good thing. That receding tide economically is going to expose a bunch of scammers. It's going to expose ideas and concepts that really don't meet the test of intellectual rigor in terms of capitalism. And that's good. That's why a recession, a moderate recession, can be a good thing. And the longer it's delayed, the more likely we are to have a catastrophic 2008. So were we to have a recession right now, it wouldn't be a bad thing. Now, it would sound like it because media sells soap, so they would tell us all that it's the end of the world. But the fact is that the recession would actually be better for us in the long run. So what does a normal recession look like? Well, there is no such thing as a perfectly normal recession, but let's look at the averages in history. First thing is, it starts out with an inverted yield curve. It starts out with an economic boom. It starts out with inflation. We've got all those criteria being met. Then what happens is interest rates start to drop, earnings start to decline. People like to think we're going to have a soft landing. The stock market isn't taking it seriously yet because investors expect that the Fed will stimulate. What happens next is that corporate earnings decline. That's when we officially go into a recession, and unemployment goes up. At that point, and this is key, the stock market goes temporarily down. It can go down as, I think an average is something like 30%. That's a lot. That's 1/3 of the value of the stock market. It's going to go down, and it's not going to stay down. The other thing that happens, and this will explain why our portfolios are allocated the way they are allocated. Interest rates go down. Even if the Fed doesn't stimulate, interest rates go down because money demand drops. So interest rates go down. What does that mean? That means that while the stock market is going down, the bond market is going up. That's our chance to recover our losses from last year in the bond market. That's why we've been extending maturities slightly. That's where those hybrid funds are going to make wonderful money should we have a typical recession. So stock market down, interest rates down, bond markets up. So our portfolios are diversified with that scenario in mind. Should a recession get awful and turn into 2008, credit quality is going to become an issue, and that's when we want to be in treasuries, not in corporates or high yield. That's why we're not in corporates and high yield right now. I actually think we're more likely to have a normal recession than a 2008, but who knows? Now, gold. Gold works when people are worried. Gold has kept up with inflation. Gold is entirely unpredictable. It can go up. It is correlated with declining interest rates. So a recession will make gold go up usually, not always. And if the recession is slow to recover, which is not a guaranteed thing, if it's slow to recover, gold will keep going up because gold, like Bitcoin, is subject to manias. So gold can go up unexpectedly and keep going up. But at some point, gold usually collapses because you can go over to the stock market, which becomes a bargain because it's gone down. So gold is good for a short-term ride. It's good for disaster proofing your portfolio, but those disasters always end, don't they? To review, a recession, if we have one, and we may not have a recession, we may have that soft landing. If so, it would be the first time in history. Basically, earnings down, stock market down, interest rates down, bonds up, we make money, gold up. So that's the recession. That's what a recession normally would do. We're configured kind of agnostically in the middle here, but we are configured for such a challenge. So let's prune some dead wood. Let's enjoy spring. Let's be patient. Avoid the media, which is going to scream like, it's the end of the world. That's what they do. But a recession is a normal and even healthy thing. Thank you. Blessings.